Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site is Michael Normyle, U.S. Economist at Nasdaq, and Chris Dearborn, Managing Director on the Nasdaq Market Intelligence Desk. We're here to discuss the probability of a rate cut in September, with investors questioning if it will be 25 bips or 50 basis points. It is great to see you guys. As always, welcome back to Trade Talks. It feels as if this is somewhat of an inflection point, Michael, where the data is starting to have investors question if it's time for the Fed to make a move here.
Yeah, I mean, we got obviously the unemployment rate a week and a half ago, and that of course caused a lot of drama in the markets. And then yesterday we had the PPI inflation come in a little bit better than expected. Similar story for today with CPI pretty close to expectations on year over year, a little bit better, down to 2.9% from 3%. And for core down to 3.2% from 3.3%. So a lot to like though in the data for CPI. You can see that core services ex rents, kind of the super core inflation that was really top of mind for a while, that's down to 2% on an annualized basis. So a lot of things are moving in line where the Fed wants them. Rents were a little bit higher inflation than we would have liked to see this month, but maybe that turns out to be noise. We'll see.
And speaking of noise for a moment here, Michael, when we saw that volatility pop last Monday, there were some that were almost hysterically calling for an emergency rate cut in between meetings. To me, that would have been the shocking moment, because if you get an emergency rate cut, there's something really wrong.
Yeah, exactly. Historically, there haven't been a lot of them except in really dire circumstances, like financial crises, early COVID, those types of things. So I think you're right, that would have been more of a kind of increasing people's concern about the economy than taking time to say, okay, this is one report. We don't know, sometimes it could be revised. There was things going on with hurricanes that could be impacting it. So let's wait another month, see what happens. So I think it's probably the prudent thing to do. Maybe the more prudent thing to do would have been to cut in July. But
right, and that's the argument that you were making,
right.
Chris.
Absolutely. Yeah. They were one day ahead, the non-farm payroll report. If they cut a quarter basis point, it's not going to make a difference one way or another. It's just signaling that the data is moving in that disinflationary track that they've been looking for. Right, wages are slowing down a little bit. Unemployment is ticking up a little bit, but not egregiously. Right, it's not like the COVID numbers that we saw. And even though CPI and PPI are trending the way that's not what they look at. Right, the PCE is it's still trending at what, 2.5%, right?
Yeah, 2.5.
And it's going in the right direction. So everything's working the way it should. And if you look at what the Fed fund futures were pricing in a week and a half ago, it was 80%, and it varied on day to day, but at one point it was almost 80% of a 50 basis point cut. Now we're at less than 35% of a 50 base, 65 for a quarter point, which is where it should be. And if you listen to the press conference and everyone's talking about it at nauseam, he's basically saying, yes, we're going to cut in September. The question is, does one cut lead to multiple cuts through the rest of the year? I would think so.
But why do you think they should have cut it July if things are fine?
Because they would have been ahead of the non-farm payroll report, and it would look like they had the finger on the pulse of everything. Remember, the data is backwards looking that they're looking at, and that's what they're looking back. They're not looking forward, and that's always been the case. When we went into the rate hike cycle following COVID, inflation was already peaking at 7, 8, 9% before they even started to raise rates, and then we had 3/4 point raises over that summer, and showing you that they were behind the curve and they were trying to push it. So we don't want to see that same cycle on the way down in the cutting phase of it, and if that's the signal, again, means that they are behind the curve, and that's the fear.
And that's a great point that Chris makes, Michael, because it takes 6 to 9 months, 6 to 12 months for rate hikes, and on the same thing for rate cuts on the way down. So even if we get that 25 or 50 basis points, it's not really going to be reflective or felt in the economy for at least 6 months out.
Right, and like you're saying, 25 basis points anyway isn't going to make a lot of difference other than kind of signaling that the Fed is on top of this. They recognize where things are headed, and they're just getting the ball rolling. They're not overreacting to any one data point the way they didn't overreact to inflation coming in higher than expected in the first quarter of this year. So I think that's right. It's really getting the ball rolling on this. Hopefully they're doing it soon enough to get ahead of any kind of trouble in the labor market. If you tear apart what happened with the unemployment rate, it looks a little less concerning, where it's not a lot of layoffs. It's some people finishing temporary jobs. It's people joining the labor force. So it's not like a kind of classic we're losing jobs type of situation.
Right. That's something people don't talk about as much, the labor force participation rate. You're seeing more people moving their way back into the work. and that's a good thing. So obviously, if you have more workers, you know, it was it's 1.2 jobs now for every one searcher, somewhere right around
So
that
a little
point.
bit of a downtick.
A little bit.
Yeah.
I mean, right after COVID, it was 2 jobs for every one.
Right.
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 So
Which was an anomaly.
But 1.2 is still pretty good.
Right.
Yeah.
Right. Historically. So, and if you have more people working, yeah.
Well, let's talk about pretty good for a moment here, Chris. So in December, we saw the market run because they're expecting 6 to 7 rate cuts, which in my mind is a little bit scary if you get that many rate cuts in one year. However, we were hitting all-time highs based on fundamentals for the most part, not necessarily rate cuts. So in my mind, it's showing that corporates, they've been pretty diligent and have handled this higher interest rate environment pretty well.
To a point, yes.
Right.
Right. There's always
Well, certain sectors, of course.
Right. To a point. I mean, rent is still a problem, right? And rent, you know, accounted for almost what 80% of this month's number.
Something like that.
Yeah. So it's still hanging up there, but rent is always a laggard, right? So it's not really doing anything that it hasn't done in the past. Everyone's just kind of hyper focused on and expecting it to change month over month. But if you go back to fundamentals, and we'll talk equities, you know, if we didn't have the AI phenomenon start out the end of last year and beginning this year, this market wouldn't be anywhere near where we are right now, right? And if you look at the major indices, you know, the Nasdaq, S&P 500, the Dow, they're all acting well or well enough when the Russells, you know, had a great year in July and it's given it all back. You know, and when you look at that, we're down 5-ish% for the month here right now in the Russell. You know, it's the same story that everything's moving along. The have and have-nots, you know, the top 7 mega cap companies, and then the rest of the 493 in the S&P 500. You look at the earnings of the Russell, and you know, it's still, even though we had the reconstitution, you know, back in the end of June, you know, the companies that replace, even though they're cash flow positive, some of the ones that come in, majority of them are not. So it's still that 40%-ish base of companies in the Russell 2000 that cash burn, which means that the rate cut cycle will be very beneficial for them moving forward. Depends on how quickly it happens. If that happens, you're going to see the Russell start to pick back up again. So again, the AI phenomenon, I think, is what was the height of this market rally based on the Mag 7.
Well, it's so interesting because BlackRock had filed recently that they are launching an ETF based on the Nasdaq 100. However, names 31 through 100, right? So if you see an issuer the magnitude of BlackRock issuing an ETF such as that, kind of read in between the lines there that could suggest that there, you know, that there are catalysts for the, you know, 31 through 100 names.
I mean, people, you know, when you look at investments, you know, ETFs are a great way for people to take advantage
Right.
of a larger swath of companies, and if there's appetite for that, that should take off very nicely.
Right.
You know, some people want to, when we talk about index performance, we talk about the equal weight for the S&P, equal weight for the Nasdaq 100 to the actual weighted, and you can see how different the performance is for both of them. Maybe that gives folks an opportunity to invest in that. It's kind of interesting.
So
I haven't read that.
Bloomberg reported it on Monday.
Okay.
Yep. In terms of earnings, how would you grade it so far?
I mean, I'm not the earnings expert
Right.
necessarily, but I think it looks pretty good.
Yeah.
Where we're seeing, to your point, with looking at the Nasdaq 31 through 100, we're seeing that broadening out in earnings, where it's really not just the Mag 7 with positive earnings; it's the rest of the S&P 500 seeing positive earnings. So I think that's, you know.
Well, it's interesting because anecdotally, you know, we cover every single sector as it relates to emerging technologies here on Trade Talks, and the consistent theme that we are getting is, okay, we get the tech story, but every other industry is going to have to adopt it in one way or the other way, whether you are, you know, the supply chain for it, the construction people for it, the, you know, you're an industrial, I mean, Honeywell's a Nasdaq 100 company, you know what, they are known as industrial, but guess what, there's a lot of technology that goes into that transition. So I think once we start hearing that consistently, that it's going to broaden out, right? So, I mean, it's going to have to, you're going to have to adopt
It's already there. I think that track is already, that locomotive has already left the engine.
Right.
Right. You can't be in business without being technology.
There's
savvy.
still a lot of work to do.
There'll always be work to do because as things come along to upgrade everything. But if you look at the earnings growth rate, it's 10.8% for the quarter, and you've got 80%. I think you have another 50 S&P 500 companies to look for, and some big ones, which is going to be driver of GDP. Right. Look, we're very interested to see what Walmart has to say tomorrow. That is the big dog that's still up to come. And if they do well, and that's going to be coupled with retail sales tomorrow morning. So the 1-2 punch right there, if they come in off, this market will have a problem, right? Not that Walmart carries as much as the Mag 7, but it does carry.
Well,
and if
it's
there's
consumer.
questions on consumer spend,
Well, you
that's
cover consumer
two-thirds, that's
names on the Markets
two-thirds.
Intelligence Desk. What are your issuers telling you?
Well, a lot of them are still in the quiet period. Remember, retailers report later
Let's
on
call
in the
over
cycle.
the past 2 to 3 months how they feel about the consumer.
I'll even go better than that. Well, since Q4, everyone's been warning. Everyone has been warning for the most part. There are the haves and have-nots. Big box stores are doing well for the most part, but retail fashion is suffering, and those who import dollar stores have been suffering. So you're seeing a lot of that trade down not happening for people. The people in the lower end of the bucket on the consumer just are doing without right now. So you need to see that start to change, and I'm not really sure if Q2 is going to be that change. Remember, retail for the most part needs Q4 earnings to kind of get back into the black. Right. And to the point before about earnings, the midpoint and the tail of the S&P 500, generally in Q3, Q4, start to catch up to the earnings cycle for the larger cap companies coming through.
Although everyone has a Prime Day or whatever they're calling it in July. So you wonder if a lot of these sales have been
that's going to be very, very interesting to see what the retail numbers are, because it will include the July Prime Day.
Right, of course, and you pitch that along with, all right, let's buy everything we need for college, and then you're pulling Prime Day ahead, and it's not just Amazon.
No, it's not. But it would be very, very interesting to see what they say. Tomorrow's numbers and tomorrow's Walmart release are going to be very important for the market, not only for sentiment, see how the consumer is, but also it's going to be an interesting look in the GDP, because people are going to be plugging those numbers right in.
Of course, but it's been hard to bet against the consumer. They still continue to perform.
Yeah, I think the one question is how sustainable is it? Because if you look at things like we got data at the end of last month on real personal income growth, real consumer spending growth, and if you look at that, spending growth is growing faster than income growth, and you can't do that forever, essentially.
Right.
So, we need to see that come back better into line. It doesn't mean that consumer spending growth needs to go negative, but it just needs to get back into line with income growth.
As does our fiscal policy, which of course we'll be hearing about that over the next couple of months or so. And of course, these headlines are going to be amplified as it relates to the economy, just because of where we are in the election cycle as well. But again, even when we think about liquidity just doesn't mean dollars in the system. Liquidity can count as credit in the system as well, right? So I mean, there's a number of factors that play into it.
I just keep my eye on the 10-year, right?
Right.
We're below 4%. It's waffling between 3.82, 3.85, right around that ballpark. The 10-year will tell you where we're going with the marketplace. And if the disinflation track continues, rate cuts start to come to fruition, and as long as they're managed orderly, not like the rate hike cycle, like I mentioned in the beginning, with 375 basis point hikes, this will be a nice transition, and you'll start to see companies start to ramp up on earnings, because then that PE starts to get a little bit better.
All right, let's leave it on a positive note. Appreciate both of your insights. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.